to what I hope will be the first of many Wealth Advisor Model Portfolio and Strategist Summits. This is where we really delve into the market strategy, obviously, but also just developments within investment management, within asset allocation, and really in a year where traditional solutions have failed, shall we put it that way. I think it's good to take an afternoon and look for new ideas, look for what's coming out that worked, who can actually beat the benchmark, who can actually help your clients make the RMDs. And then we're looking for where the solution sets might be to make that as easy as possible, because let's face it, the 60-40 portfolio made a lot of clients angry this year. I'd like to emphasize real diversification, dynamism, discipline, and just going beyond passive buy and hold forever. That means active risk management. It means better indexing, and that's what Leigh Eichel does every day. He's with Alpha V. And Leigh, thank you very much for being here. What are you seeing, and how are you providing solutions?
Scott, thanks. Thanks to the other panelists. It's actually great to hear Jerry, Gary. We echo a lot of the same information. We're getting a lot of reads on the same kind of data. And what's also interesting, maybe to point out to the audience, none of the panelists got together before this to prepare their results, their PowerPoints, etc. So it's funny to see how much alignment there is, and I'll be eager to continue to watch and learn from others. Let me just share my screen for a moment. In this chart kind of ties off with what we heard from Gary, etc., that keeping perspective is key. Fascinating to see the charts and the data on the grizzly bear and the teddy bear markets. And I always like to lead off on this because as we think about risk and risk management, Alpha V is probably best known for its risk management and its disciplined style. And all the white papers we do on this concept of fundamental momentum. My skin crawls whenever I hear people say, is it risk on or risk off time? I also agree with the other panelists. Risk is ever present. There's always risk. I've never thought of it as a light switch. It's not on or off. It's more of a dimmer switch, if anything. Risk is variable. It's always there. And there's continuous temptations to sell. I always remind advisors and others to take a look at this chart. Yeah, it hasn't been updated for the latest war in Ukraine and talk of nuclear war and these larger macro events. But we can see dozens of other times when if you tried to time and get in and get out, or if you didn't use smart alternative strategies like some of the ones we're speaking today, that you would really miss out. So please keep the data in mind, keep those 3 to 5 year time horizons in place. And as you said, Scott, waiting till mid next year can be a long time with some clients. But again, this is when you pull out one of these charts to let them know that 6 months really isn't that long in the scheme of things if you have the right strategy and you're working with the right investment research partner. So, I'm gonna steer away from, I guess, the group a little bit because I keep a pretty close look. We do a temperature check of the markets every 2 weeks. You're going to see a little bit about our process in a moment. And so I look at some other indicators that haven't been spoken about yet. And Bank of America came out and you had Brian Moynihan talking about what they're seeing. And when you look at the consumer, they're seeing a lot more transaction volume in September than the first half of October. Of course, that's encouraging. We see account balances that are higher before the pandemic. So also, I was encouraged to see that. Again, it's easy to get stuck into the doom and gloom, and there's plenty of it. I don't want to discount it. It's not rosy, but I think more or less in 90-day increments of time, right? So quarter by quarter. And not to forget the forest when I'm looking just at this quarter's worth of trees, but that was an encouraging sign. And And then I look at the credit. Consumer credit still is pristine. Late payment metrics are well below these pandemic levels. Most consumers haven't had much difficulty keeping up with their debt. Very encouraged by that. And then, you know, you have an unemployment rate. The percentage is, you know, in an encouraging range. It's still considered a support range that unemployment isn't too high. It's, if anything, still maybe on the tighter side. That could also, the flip side, support that the Fed continues, as we all expect, and I would tend to agree, will continue to strengthen going in. So that begs those questions. Are we near a bottom? Probably not. But should we be concerned about, as we look forward past this quarter, about what's the sustainability of growth? What about rising costs? What about all these other potential negatives? And the way I kind of decompose or deconstruct risk is we think about our portfolios through what I call risk lenses. So the first thing I want to think about is, well, in the market itself, when the market goes down, even great value, great deals, good stocks decline. So what kind of indicator should be in place? And we use an indicator that looks at quality and value and a little bit of momentum. And then when we look at inflation, we have another risk lens. When inflation is, you know, in an elevated state, what should we use for an uncorrelated asset class? And in this kind of bear market where almost everything other than cash, should we use standard treasuries? We use TIPS instead of something like the intermediary, the 7 to 10 year IEF. Then I look at sectors. We do our fundamental momentum roll-ups. We're looking at peer group rankings of those sectors. And we have an indicator that we look at that too, because again, if I can steer some alpha into a portfolio by finding the sectors that are accelerating and steering away from the sectors that are decelerating, that's great. We should do that. And finally, we do what a lot of people do. After I know which sectors I want to be in and what allocation to equities I want to have for the coming 90 days, then we'll pick names. And again, it's all very systematic, very disciplined, all based on boring fundamental roll-ups and analysis and valuation models. So that's a little bit about our, you know, our process to maybe peel the onion a bit more, right? Because again, all this work that we do ongoing every day for our clients, it's to, you know, the term I use, I guess speaking with advisors, is though CAGR grows everyone's business, it's the active standard deviation or below benchmark standard deviation that keeps the business and keeps the phones from ringing. And that's what we work so hard to do. So we monitor a trend line of the reported boring rear view mirror facing fundamentals over 1,000 companies. And we look at those trend lines and we kind of deconstruct it, as I mentioned, in terms of what's the value trend line, what's the quality trend line of that large section of the market, and look for any trends that might be emerging. I do the same thing for sectors. I should say we do the same things for all the sectors and look for sector behaviors and which sectors are accelerating and decelerating. And that's what we call fundamental momentum. So not price momentum, but where are the fundamentals going? So what we saw to tie this together coming into this quarter, and for the whole year, very conservative. And we were in TIPS, though they've been punished heavily. We had a little IEF and then now TIPS. And it's been a rough ride. Are we generating alpha? Sure, we're generating alpha. Are we below the benchmark standard deviation? Absolutely. And going in October 1st, we went full on equities, not full on, but 90% equity exposure, 10% TIPS. In our leading models. We do have long shorts also that are positive for the year. And we're very focused on the value and quality, you know, like everyone, I'm looking for those dollar bills that I can buy for 80 cents and trying to pick those up for this coming 90-day period. Going into Q1, our research results will be available December 16th. So I'm not gonna go beyond to what our portfolio positioning will be for that coming quarter into Q1. And long-term horizon forecasting farther out than 6 months, and this kind of market is tough. But I think what we've heard and the data we've seen from the other panelists, I would tend to agree with. And I'm just going to summarize it at this. You know, our results speak for themselves with fundamental momentum. These are long only models. We have, like I said, long shorts that are fully positive. But right now things are executing as I believe they should, and as we would expect, with plenty of alpha and a much less bumpier ride. But you got to go back to that first slide of keeping perspective in this kind of market, and that all things come to a pass. Recessions will end, wars will end, pandemics end, and we move forward from that point. So having risk-based strategies and risk-managed allocations absolutely is what clients should have large portions of their portfolios in today. I'm going to stop there, Scott, for now.
Well, Mr. Eichel, thank you very, very much for that, because again, plenty to chew on and plenty for people on this call to reach out to you later and maybe start a conversation, because
Absolutely.
I know we're only scratching the surface of all of y'all's expertise.
Absolutely.
So thank you very much. And